Why is the market buzzing with activity as November comes to a close and December kicks off? Join me as we delve into the week's key highlights and explore the implications of Federal Reserve Chairman Jerome Powell's recent statements on interest rates. As we transition from November to December, the markets are showing resilience, pushing higher despite the cautious tone set by Federal Reserve Chairman Jerome Powell. Powell discussed the possibility of more rate hikes and emphasized that talk of rate cuts is premature. The market, however, seems to be taking these remarks in stride, with indices posting gains. Powell's commitment to maintaining a restrictive policy until inflation is convincingly back to 2% signals the Fed's cautious approach. Despite positive indicators suggesting a decline in prices, Powell stresses the need to avoid premature conclusions. The delicate balance between not doing enough and doing too much in terms of controlling inflation remains a key challenge for the Federal Reserve. The market, as always, attempts to anticipate the Fed's moves, pricing in rate cuts even when Powell emphasizes otherwise. This discrepancy highlights the challenge of aligning market expectations with the Fed's projections. Powell acknowledges the uncertainty in the economic outlook, especially regarding inflation, interest rates, unemployment, and GDP growth. The market's response to Powell's remarks is reflected in the performance of major indices. The Dow Jones, S&P 500, and Nasdaq are all seeing positive movements. However, there's a noticeable rotation of money out of the technology sector, with Meta, Tesla, Google, Microsoft, Amazon, and Apple showing some struggles in the past few days. Examining the technical indicators, the S&P 500's RSI reading is notably high, surpassing the 70 threshold. This suggests that the market is in an overbought condition, occurring only around 10% of the time historically. Such levels often signal caution for investors, urging them to assess the risk-reward dynamics carefully. On the other hand, market volatility is relatively low, sitting below the 15th percentile. This implies that the market has been on a consistent bull run, but the current low volatility raises questions about potential future shifts. The Nasdaq's percentage of stocks trading above their 200-day moving average indicates that more than half of the stocks in the index are back above this crucial level. While this is not uncommon, it's essential to monitor as it impacts overall market sentiment. Short-term technical indicators, such as the percentage of S&P 500 stocks trading above their 20-day moving average, suggest an overbought market, with nearly 90% of stocks trading above this level. Moving to the S&P 500's valuation, it's trading just under 4,600. Considering earnings expectations for 2023 and 2024, the current valuation places the S&P around 21, slightly higher than historical averages. The earnings yield is just under 5%, competing with Treasury yields. This prompts investors to carefully evaluate the attractiveness of equities relative to bonds. Examining historical market data, the S&P 500's RSI, and volatility levels, it's evident that the market is in a rare state. Seasonality, however, suggests that December tends to be a strong month for the market. This creates an interesting dynamic with the overbought technicals, leaving investors to speculate on whether the market will witness a short-term pullback followed by a rally or a robust upward trend followed by a pullback. Amidst the broader market analysis, individual stocks like Apple, Amazon, Tesla, Google, and Meta are exhibiting various technical signals. Some are still riding the momentum, while others, like Netflix and Google, show signs of weakness. This divergence emphasizes the need for investors to adopt a discerning approach, assessing each stock's unique technicals and potential risks. As we look at specific stocks, companies like Costco and Enphase continue to showcase strength, hitting all-time highs and showing resilience even in the face of overbought market conditions. However, stalwarts like Microsoft and Google are starting to display signs of weakness, indicating potential shifts in sentiment. In conclusion, the current market scenario presents a delicate balance between technical indicators, seasonality, and Federal Reserve policy. The overbought conditions signal caution, prompting investors to reevaluate risk-reward dynamics. While short-term pullbacks are possible, the market's seasonality could influence a strong December rally. The key is to stay vigilant, adapt to changing conditions, and carefully consider the risk inherent in current market dynamics. What are your thoughts on the market's overbought conditions and the potential impact on specific stocks? Leave a comment below. In a broader perspective, the situation may affect demand and pricing of individual stocks differently based on their unique fundamentals and technical signals. For example, stocks that have shown signs of weakness may experience more pronounced declines, while resilient ones could continue their upward trajectory. Disclaimer: this content is for informational purposes only and should not be considered financial advice. Always do your own research and consult with a professional financial advisor before making investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information, and it helps us spread the message. Sharing is caring.